We are going to take a look at Libor, but it's so interesting because the big story right now, the theme, rising rates, the 10-year yield in the spotlight almost at 3.1%. But yes. Libor, you have a great chart, a long-term chart, a pattern that I happen to love. I haven't heard too many other people talk about this pattern that suggests that we could see a big spike higher. Can you talk to our viewers about this?
Sure. This is the Libor from 1989, its peak of 10.65% over here, the low of 0.2223% down here. And
what a move.
Yeah, huge. And in terms of classical chart pattern analysis, you have a bullish falling wedge. Note that the lines, the resistance and support lines are converging. Unlike a downtrend channel where the lines would be parallel, these lines are converging. It reveals waning downside momentum, and it's a big bullish bottoming pattern.
Agreed.
Which is about to signal a confirmed long-term low by breaking above the long-term downtrend resistance line.
For a true confirmation, though, you would probably want to see a move back over above that last high back in 2005. And then would you expect that to mean an equal move back above 10% that we saw in 1989? Or what are you looking for here?
Well, in Elliott wave terms, what you have here is a big A, B, C, D, E. And typically, you correct one of those with a 618 retracement. Okay. Which is going to get you up to some pretty lofty levels, well above the prior high. So it's true, this would be kind of your early warning signal, taking out this.
Agreed.
Confirmation would be taking out the prior high, because then you no longer have a pattern of lower highs and lower lows.
That could be pretty painful for the economy, certainly, if that happens, really raising borrowing costs. Now let's take a look at oil, because I love this chart of oil, and I know that you love it even more than me.
Yes, yes. So this is net speculative length. These are the funds. They're net long position.
Okay.
And the first thing that strikes you is the stupendous pile of speculative length. But the other thing that's remarkable is it peaked back on January 23rd of this year.
Oh, yeah, lower lows now, or lower highs.
Yeah, $66.66 WTI. And note that this has been making lower highs, even though WTI continues to make new highs.
So that's a divergence. What do you think it means for
absolutely.
price?
Well, I think it means that not even the bulls trust this and believe it from here, because it's highly unusual that funds would not be adding to length into new highs. And so you got to wonder, what the heck are they doing? Aren't they long about Saudis and Russia? What happened on January 23rd, that's where the net length peaked? That was the high in the Dow Jones Industrial Average, the global Dow, the S&P 500, and the S&P 100. And there's a very good reason why they should be looking at what the stock market is doing.
Well, let's talk about the stock market, because the last time you joined us, you brought up the idea of a tax bubble. And we have a great chart here of the Dow and the NASDAQ. So update us on your view here.
Well, the first thing is...
And there's that peak you were talking about in the Dow.
Yes. And this is January 26th. And in every previous stock market bubble, the Dow peaked first, and then the NASDAQ peaked later. So this is exactly what the credit bubble peak looked like. It's what the dot-com bubble peak looked like. And, you know, it's been a long time since new highs in the Dow.
You're right about that.
And I think the connection to crude oil here is during the bursting of the dot-com bubble, crude oil lost 62% of its value. Actually 55%. It lost 62% during the Asian financial crisis. So burst equity bubbles are bad
So it
news.
sounds like you are bearish and cautious on both stocks and the economy. Walter Zimmermann of ICAP Technical Analysis, thank you so much.